It is the 19th of December 2022. My name is David Hickson, and in today's market update we're going to be taking a look at the S&P 500 and in particular discussing the impact that news events have on financial markets. I am traveling at the moment, and so this video will be a bit shorter than our usual market update videos. I apologize in advance if the quality of the audio and the video is not up to its usual standard. Let's take a look at the S&P 500, and I'm working with data up to the close on Friday last week. This is the analysis we've been looking at for many weeks, many months actually. We've been developing the picture in terms of the S&P 500. You will know that this trough over here, which you can see has been phased as a 20-week cycle trough in the middle of October, is potentially, of course, of 20-week magnitude, but it might also be of greater magnitude. I've discussed in previous market updates the possibility that it could be an 18-month cycle trough. I've discussed that discrepancy between the different magnitudes of that cycle in previous market updates, and so if you are not familiar with that argument, I'm not going to repeat it in today's video. I would encourage you to go back and take a look at previous market updates about the S&P 500. You will know that in my previous market update last week about the S&P 500, I was discussing the fact that the S&P 500 is expected to come down into an 80-day cycle trough around about Christmas time. Here is the nest of lows for that 80-day cycle trough. And so in terms of the cycle picture, absolutely nothing has changed. But last week provided us with an interesting situation because there was a news event, or the release of some figures on Tuesday. That was the 13th of December. CPI figures were released, and you can see that the market did an interesting thing. In last week's market update, I spoke about the fact that we had confirmation that the 80-day cycle peak had formed in the market. And it is still my opinion that the 80-day cycle peak should be correctly positioned over here. That's in the last week of November, the last few days of November, or perhaps on the 1st of December. And so it is still my opinion that the 80-day cycle peak formed at that particular time over there. But on Tuesday, as you can see, an interesting thing happened, and let me just clear all of these markings. An interesting thing happened because on Tuesday, price poked its head just up above that level from the 1st of December, or the last days of November. It poked its head up above that level and then dropped down again. That was interesting, and it is something that you do often see when there is a news event or the release of some figures that are of importance to the market. In terms of the cycle analysis, as I've mentioned, absolutely nothing has changed. The market is now moving down into the 80-day cycle trough. Whether we position the 80-day cycle peak over here, which is where I believe it should be positioned, or whether we position it over here where we had a slightly higher price on that Tuesday with the results from the CPI figures, is really an academic argument. In my opinion, the 80-day cycle peak occurred at the beginning of December, and this was simply the result of a news event. I'm going to take a look at a little more detail in terms of that news event to explain how I believe news events impact financial markets. I think it makes for an interesting discussion. But let's first of all consider this 80-day cycle trough. Let's take a look at our 20-day FLD, and you can see that price crossed down below that FLD over there. That would be an F category interaction in our sequence of interactions that occur between price and the FLD of each and every cycle. Then we had price come up and find resistance. That was what happened in that news event on Tuesday, and price on Wednesday also straddled that FLD a little bit, and that would be a G category interaction. Then, of course, we have our H category interaction, which is for the final move down into the 80-day cycle trough. Where is that trough likely to occur? I displayed the 40-day FLD in last week's video and generated a target as a result of price crossing below that 40-day FLD. That target has now been reached. So what comes next? Let's add some longer FLDs and display those. Here is the 80-day FLD. The interesting thing about the 80-day FLD is that if this trough over here in the middle of October is of 40-week magnitude, In other words, if it is of greater magnitude than 20 weeks, then we would expect the 80-day FLD to provide support as the first 80-day cycle trough forms following a trough of at least 40-week magnitude. Because we still have some question marks surrounding the absolute magnitude of this trough over here, it is going to be interesting to see whether the 80-day cycle FLD does provide support. If it does, then that would increase our confidence in the fact that this is a greater magnitude cycle trough that formed in the middle of October. If price slices down below the 80-day cycle FLD, it will of course generate another target to the downside, and it will imply that the trough in the middle of October was of only 20-week magnitude. In other words, we have a greater magnitude cycle trough waiting for us early next year. Another potential target for the 80-day cycle trough in terms of price is the 20-week FLD. You must remember that all FLDs provide support and resistance at various times in the progression of the sequence of interactions between price and the FLD. So every FLD is of some interest. If price fails to find support at the level of the 80-day FLD, it is quite possible that it will cross down below it and then find support at about the level of the 20-week FLD. So that is another FLD that we will be watching closely. The composite model line is a useful tool that I've displayed many times in these market update videos. It takes all of the information from the analysis performed on the chart, recombines it, and produces a line which indicates what would be expected to happen if the cycles continue to beat with the same rhythm and the same amplitude. In other words, the same wavelength and the same amplitude as time progresses. Now, the interesting thing about this composite model line, first of all, it does match fairly closely the price action that has happened in the recent past. It is, of course, projecting an 80-day cycle trough around about here, about Christmas time. Then we would experience a bounce out of that trough. The interesting thing about the composite model line here is that it is projecting a bearish M shape into the trough early next year. Oops, that's a bit of a mistake with the laptop. There we go. And so we're looking for a bearish M shape into that trough in March. That is on the basis of the assumption that this is a trough of only 20-week magnitude. As mentioned in previous market update videos, if the magnitude of the trough in October is of greater than 20 weeks, then of course we would see a bullish M shape. The interesting thing about this composite model line, as I think you can see here, is that the peak in terms of the 80-day cycle peak is in fact positioned over here, not here where the news event caused price to pop up above that previous high level. And so I would like to spend a moment speaking about the impact that news events have on financial markets. Let's zoom in and take a closer look at what happened last week. Here is the price action on Tuesday. You can see that price opened in a fairly normal way, fairly close to the close of the Monday's trading action. It jumped up again and then down again, providing us with a bit of a pin bar. I know there are other terms for this kind of bar over here, but you get a very long and extended shadow, whereas the body of the candlestick bar is fairly small and down at the bottom of the bar. That's the kind of price action that you will often see when there is a news event. Many people place great importance on these news events and the release of economic figures. In my opinion, what tends to happen around a news event or the release of economic figures is that the market will react often with a great deal of volatility, but it in fact does not very often change the cycle picture, and that is what has happened in this case, in my opinion. The news event provided a great opportunity for very big players in the markets, and I'm looking at the banks here and very big hedge funds and so forth, who have the ability to move the markets simply by their trading action. It gave them the opportunity to drive the market with a little bit of extra volatility, to catch some of the stop orders that were in place. The important thing to remember is that wherever there is a high point or a low point, you will have a bunch of orders that are placed just above that level. That's not a very straight line, but you can see that the high price over here, I think that was on the 1st of December, was it, would have been a natural stop loss level, perhaps for people who were in short trades, and possibly an entry level for people who were in long trades. What tends to happen during news events is because many people step back from the markets because of the fact that they move so quickly during those news events, the big players have the opportunity to drive prices up to pick up those stop orders, whether they be stop losses or stop entries, and having driven the price up there, it immediately turns down again. It's quite difficult to understand this kind of influence on the price action on a daily chart. So I thought it would be interesting to take a look at some intraday charts of that Tuesday price action to understand how the news event was in fact little more than a burst of volatility and not anything particularly meaningful, particularly in terms of our understanding of what the cycles are doing in the markets. So let's take a look at a 4-hour chart to start with to understand what happened on that day. Here is the 4-hour chart and roughly the same kind of zoom scale. You can see we have the 20-week cycle trough over here in the middle of October. Here is a very nice and neat stack for the nest of lows for the 80-day cycle trough that we're moving into. If we zoom in on the price action, you can see that on this Tuesday we had a 4-hour bar where price shot upwards, and then another 4-hour bar where price returned to roughly the level at which it started. That's the kind of thing you'll often see in a news event. Price runs very strongly in one direction. It usually reaches a level which could be considered a support or a resistance level. It's a level where there are many outstanding stop orders. It usually just breaches that level and then turns around again, and we end up where we started. Let's take a look at an even shorter time frame chart. We'll take a look at the hourly chart. On the hourly chart, we can see that the 20-day cycle trough has been phased over here on the 7th of December. Price is now moving into a 10-day cycle trough, which was expected on the 17th of December. Of course, we are now over here on the 19th of December, so it will be interesting to see today whether price action confirms that a 10-day cycle trough is formed. This is the final 10-day cycle trough in the 80-day cycle. Here is the whisker for the 80-day cycle trough that looms ahead of us, expected, as I've mentioned, at about Christmas time, which is, of course, at the end of this week. It is certainly possible that the 80-day cycle trough could form now. There is the whisker, indicating that it is possible. But it would make more sense for us to experience one more 10-day cycle. Let's focus on the price action surrounding this news event on Tuesday. If we zoom in here, we can see a very strong 1 hour in which price moved up very strongly. That was when the actual news event was scheduled to occur. And then, of course, price fell straight back down again and ended below the level at which it had started before the news event. Let's take a look at a shorter chart, the 15-minute chart. And on the 15-minute chart, things become interesting. This bar over here is the bar for 15:30. This is in the time from which my data comes. That was the time of the actual news event or the release of the figures. And you can see that in the 15 minutes prior to the official time at which the figures were announced, price started moving. And then you can see a clear jump between the close of this bar and the open of the next bar, which was at exactly the time that the news event or the figures were released. You have to ask yourself whether in that split second at which the figures were due to be released, the information that was being released, the numbers that were being released, did they cause that price jump? I would have to say no. What caused that price jump was the fact that everybody knew that the figures were about to be released, and the very big players had the opportunity to move price very quickly. You can see that in this 15 minutes, they managed to move price. Well, first of all, it jumped all the way up to this level over here and opened at this level. Then, of course, it moved up. It took out the previous high, as already mentioned, on the 1st of December. It came all the way down again, and it came back again. So you can see there was a lot of action in that 15 minutes. Was that price action a direct result of the actual figures that were released? I would certainly question that and say that, in my opinion, I don't think it had anything to do with the actual figures that were released. It was simply an opportunity for the really big players to move price. And so the release of these figures were a time where the big players could move price, take out stop orders and so forth. The actual figures themselves in that first 15 minutes made very little difference, in my opinion. Finally, let's take a look at a 5-minute chart. Here are the 5 minutes prior to the release of the figures. Over here, we had a strong move up as people anticipated the news event or the release of the figures. Here again, we can see the price jump between the close of that bar and the opener of the next bar, which was the exact time at which the figures were due to be released. We have a very volatile bar for the first 5 minutes following the release of those figures. And then, of course, the market moved up and then moved down again. It didn't exceed the high point of those first 5 minutes of the news event or following the release of those figures. The point that I'm trying to make here is that when we have news events or the release of important figures, you will get a great deal of volatility. But that volatility is a matter of playing the game in terms of finding stop levels or levels where there are many stop orders placed. And the big players are running the stops and they are finding those stop levels, triggering orders which have been placed on trading platforms. But in fact, it makes very little difference to the cycle analysis and the cycles that we are trading. Even if you are trading a shorter cycle, a 5-hour cycle or a 163-minute cycle, which are very popular intraday cycles, I think you will see that the news events bear very little relationship to those cycles. And so, in conclusion, we are still on our way down to the 80-day cycle trough expected about the end of this week, about Christmas time. If you're somebody who celebrates Christmas, then I wish you a very Merry Christmas. I hope that you have a wonderful holiday season. The price action last week was, in my opinion, very interesting in terms of the news event and revealing the way in which news events affect financial markets, but make very little difference to the cycle picture. I do hope that you found this market update useful and interesting. If you celebrate Christmas, then I wish you a wonderful Christmas. Wherever you are in the world, I hope that you have a good week, and I look forward to seeing you next week in our next market update.